Welcome to the Can Do Residential Wrap for the second week of March 2026. I'm Sarah.
And I'm Leo, the AI voice clone of Len van Niekerk. 2 transactions, 8 days apart, a combined 4 billion rand deployed into senior living and build to rent. Not one of the 2 companies involved was willing to tell you what they expect the next 12 months to look like.
This podcast is created by Can Do World. Can Do World not only creates this podcast, they provide AI training that is grounded in sound AI governance practices. Contact us today for a free consultation about how to safely implement AI in your business. We not only understand AI, we also have a deep understanding of real estate. And that context matters.
This is a week where the institutional money did most of the talking. The REIT sector made its bets on the demographic future of South African housing. We're going to explain exactly what those bets are and why they matter, even if you're not a listed property investor.
We're also digging into the confidence numbers, specifically why the headline reading of the R4bn BER Business Confidence Index at an 11-year high is only half the story. And we have a barb this week that might make you look at dividend announcements very differently going forward.
Before we get there, NSFAS, the student accommodation funding body, is back in the news, and this time the Minister of Finance has publicly questioned whether it should exist at all. We'll cover what that means for the billions of rand in PBSA assets held by listed REITs.
Quick macro anchor to set the scene. Prime sits at 10.25%. The next MPC decision is on the 26th of March, and the professional consensus, Investec, Standard Bank, still points to a terminal rate of around 9.5 to 9.75% by year end. The oil shock that repriced things last week hasn't gone away. Brent was testing the $100 mark during the period, and we noted last episode that's the primary variable threatening the rate cut timeline. No new guidance this week. That uncertainty holds, but cuts rates are likely to remain on pause until the conservative SARB has a clearer picture of the impact of the oil price shock on inflation. Let's start with the number that dominated business commentary this week. The R4bn BER Business Confidence Index reached 47 points in the first quarter of 2026. That's an 11-year high, highest reading since 2014. And to put it in context, the long-run average for this index is 43.5 points. So we're sitting 3.5 points above the long-run average. That matters.
It does, and media got this wrong, by the way. Several outlets described 47 as near its long-run average, or a mild improvement. That framing is factually incorrect. 47 is well above normal. This is an expansionary reading relative to the historical baseline, not a middling one.
So, what's driving it? And why does it matter for residential property?
2 things worth highlighting. First, the new vehicle dealer subcomponent reached 67 points, a 13-year high. That might sound like a car story, but it's actually a residential proxy. When consumers are committing to depreciating high-value assets at this rate, appetite for residential upscaling typically follows with a 6-month lag. Think of it as a leading indicator for the 3 million to 5 million rand purchase bracket.
So someone who just bought a new car in January is statistically likely to be thinking about a bigger house by July. That's the pattern.
Historically, yes. But here's where the confidence story gets complicated. The building contractors subcomponent of the Business Confidence Index reached 50 points this quarter, the neutral threshold. That's a significant signal for the supply side. Main contractors hitting equilibrium suggests institutional development pipelines are active and progressing.
But the FNB-BER Building Confidence Index, which is the dedicated construction survey, that came in at 42 points, which is actually 1 point lower than last quarter.
Right, and 42 is exactly at the long-run average for that index. So it's statistical normalcy, not a deterioration. But here's the structural story that the composite is masking. The building value chain has split sharply. Main building contractors, up 11 points. Quantity surveyors, up 7. Subcontractors, up 5. Those are the institutional side of the market, people building build-to-rent, blocks, and integrated precincts.
And on the other side?
Hardware retailers, down 14 points. Building material manufacturers, down 13. Those are the consumer-facing side, the individual homeowner doing an addition, an alteration, a self-managed renovation. That population has exhausted its discretionary capital. The pandemic-era renovation boom is definitively over. The construction sector isn't broadly recovering. It's consolidating activity upward into institutional developers while the retail-facing supply chain bears the brunt of the consumer pressure.
The headline reads recovery. The subsector detail reads divergence.
Which is exactly the pattern we've been tracking in residential property broadly. The island strategy operating at the level of the construction value chain.
Now to what we're calling the defining structural shift of this reporting period. In the space of 8 days, 2 JSE-listed property funds deployed a combined 4.07 billion rand into alternative residential assets. Let's take them in order.
Growthpoint Properties announced a 2.4 billion rand acquisition of Aria Senior Living, done through its healthcare property holdings vehicle. This is a direct bet on what analysts are calling the retirement dividend. Buyers over 60 are liquidating larger family homes and moving into secure, lifestyle-oriented rental estates. Lightstone data confirms the number of buyers over 60 has doubled since 2000. That's not a trend. It's a structural demographic shift.
And the CGT change that came into effect on the 1st of March, we covered this last episode. The primary residence exclusion raised from 2 million to 3 million rand. That's a direct fiscal catalyst for this exact transaction. A homeowner who bought at 2.5 million rand in 2005 and sells today could save upward of 140,000 rand in capital gains tax under the new regime. That removes one of the last financial brakes on the downsizing decision.
So Growthpoint is essentially capturing both sides of that trade, the liquidity event from the sale and the incoming rental tenant. That's a well-timed capital allocation.
And then there's SA Corporate Real Estate. They announced the acquisition of Parks Lifestyle Apartments at Riversands for 1.67 billion rand, 1,960 units of multifamily build-to-rent, the largest single buy-to-rent transaction of this cycle.
And the demographic anchor for that investment is equally structural. The average age of a first-time home buyer in South Africa has risen to 37 years. That's up from 33. The squeezed middle class is renting longer. And not because they want to, but because affordability constraints, elevated prime rates, and household debt at 61.6% of disposable income are keeping them out of the purchase market.
So SA Corporate is betting that the permanent renter generation is real, sticky, and growing. And they're right, according to the data. The formal managed rental market has undergone a significant shift. The affordable bracket, rents between 3,000 and 7,000 rand a month, has shrunk from over 60% of the market in 2013 to 44.5% today. The middle-class rental bracket has more than tripled in size.
Which means the formal rental sector is no longer primarily housing the working class. It's become an enclave for the squeezed middle, people delaying home ownership until 37, and for the affluent elderly, who are liquidating freehold assets into secure lifestyle estates. Those are exactly the cohorts SA Corporate and Growthpoint are targeting.
And for the broader residential audience, what does this mean if you're a private landlord or a developer operating in the rental space?
It means institutional capital is moving into your segment with a scale advantage you can't replicate, but it also validates the investment thesis. These cohorts are real, they pay reliably, and TPN data shows tenant good standing nationally at over 83%, despite unemployment at 32.9%. The formal rental sector is resilient, partly because it's become structurally selective. The most financially vulnerable tenants have been progressively excluded as market rents have risen. The sector's resilience and its exclusivity are two sides of the same dynamic.
We need to talk about NSFAS, because this week the purpose-built student accommodation story moved from a structural risk story to something closer to a systemic alarm.
Let's set the scene. The 2026 national budget cut the NSFAS allocation by 3.7 billion rand, down to 54.3 billion rand in total. The projected deficit for 2026 is 14 billion rand. 100,000 students are at risk of funding exclusion, and accommodation applications number 224,000, while only 148,825 leases have been processed to date.
That's 75,000 students in administrative limbo. They've applied for accommodation funding. The lease is signed, but the payment hasn't been processed. Private landlords are carrying that credit risk.
And then on the 10th of March, OUTA, the organisation undoing tax abuse, released the findings of a 2-year investigation into NSFAS. Governance failures, accreditation, fraud, capacity constraints. The report is substantive and the findings are damning.
Also on the 10th of March, Finance Minister Godongwana publicly questioned whether NSFAS should continue to exist in its current form. That is an unprecedented public challenge to a state entity from the minister responsible for the budget.
And here's where it connects directly to the REIT sector. Growthpoint has increased its loan-to-value ratio at its University of KZN student accommodation exposure to 31.2%. It is increasing leveraged exposure to an asset class whose primary income stream depends on the uninterrupted functioning of NSFAS, an entity that is simultaneously running a 14 billion rand projected deficit, operating under acting leadership, subject to active SIU investigations, and now having its existence in its current form questioned by the Finance Minister.
The institutional narrative on purpose-built student accommodation has been counter-cyclical defensive asset class, and the operating logic is real. Student accommodation demand doesn't disappear in a recession, but the single counterparty risk exposure to NSFAS is a structural risk that the defensive label has been obscuring.
There is an emerging alternative model worth watching. Peyton House in Pietermaritzburg by Respublica is a high-quality private pay student accommodation development that minimizes NSFAS dependency entirely. If the direct payment mechanism introduced by acting NSFAS CEO Wasim Karim fails to process those 75,000 outstanding leases timelessly, expect a capital rotation from subsidized PBSA into private pay and open market build to rent.
And the Metro accommodation allowance remains frozen at 52,000 rand per annum. That's 5,200 rand a month over the 10-month disbursement window from February through November. In Stellenbosch and Cape Town, that's 20 to 30% below market rates for compliant accredited accommodation. That gap isn't closing, it's widening every year that the cap holds.
Here's something I want you to sit with. Both Growthpoint and SA Corporate released results this week. Growthpoint's dividend per share grew by 8.5%. SA Corporate's dividend per share grew by 9%. By any conventional reading, those are strong distributions.
And yet,
Growthpoint's distributable income per share, the actual underlying income, grew by 2.3%. SA Corporate's grew by 6%. The dividend outpaced the income in both cases by a material margin. That gap is explained by both companies aggressively increasing their payout ratios. Growthpoint from 82.5 to 87.5% of distributable income. SA Corporate from 90 to 92.5%. Both are now distributing more of their distributable income to maintain dividend optics.
So the distribution growth is real, but It's being engineered by squeezing more out of what's there rather than generating more of what's there.
Correct. And simultaneously, both companies explicitly refused to issue forward guidance for fiscal year 2026. Zero guidance. The stated reason, geopolitical uncertainty. That's legitimate. An oil price above $90 introduces genuine uncertainty into the rate cut trajectory, which flows directly into asset valuations and refinancing costs.
But take those two facts together: maximized payout ratios, absent forward guidance. What does that combination actually signal?
It signals a market in which local fundamentals are supportive enough to justify higher distribution payout ratios, but in which management is not confident enough in the near-term trajectory to commit to a forward earnings picture. That's not a crisis signal, but it's also not the unambiguous recovery signal that headline dividend growth implies. And if you're an investor using dividend guidance to make capital allocation decisions, the absence of that guidance from two of the largest listed property entities in South Africa simultaneously is itself a data point worth taking seriously.
The question I'd be asking: at what oil price does the commercial property sector's assumed rate cut trajectory actually break down? And who's modelling that scenario? That's the SA residential wrap for the 8th through the 13th of March 2026. The institutional money has told you where it thinks residential property is going: senior living and build to rent, underpinned by demographic shifts that are structural rather than cyclical. The question for the next few weeks is whether the MPC's 26th of March decision confirms or complicates that thesis.
Watch the NSFAS processing update on outstanding leases. Watch the oil price. And watch whether D's registry flow confirms the KZN South Coast investment story we covered last episode. I'm Leo, Len's voice clone.
And I'm Sarah. Thanks for listening. We'll see you next episode.